Hey, Jackie, thanks for dialing us up again this month for another webinar on some solid principles of investing. For those of you who have been here before, welcome back. For those of you who are new, we're glad to have you. My name is Rob Torrington. I'm a financial advisor at Raymond James, and my partner here in crime, co-presenter, is Barry Williams, also a financial advisor at Raymond James. So, hey, thanks for coming today. Today's topic is pretty important, so I'm going to do a little extra encouragement to try to encourage you to stay engaged in what we're going to talk about today, because it can really be impactful, not only on making good investment decisions, but also on the bottom line results of how your portfolio does the next 5, 10, 15, or 20 years. And we'll talk about the massive differences and what that could look like. So what we're talking about today is your brain and investing. The psychology and behavioral finance studies that have been done, and some of the things that we'll talk about today to talk about why you do the things that you do in terms of investing. So our purpose today is to explain why your investor behavior is important, to help you recognize that you have biases, tendencies, belief systems, and blind spots that not only affect but influence your investment decisions, and then ultimately, where the rubber meets the road, these impact your investment results. Jackie, why don't we go to the next page?
Okay, guys, as you can see on the graph, it says that seeing is not believing. This is a graph that has to do with perspective. So as you'll see, there are 3 images there, and going from left to right, there are 3 questions. With the first, it's asking which gray circle is bigger. So as you look at the image, the gray circles that are there, which one is bigger? Which gray bar is longer in the middle image? And then to the far right, which of the gray horizontal lines are parallel, or are they in fact parallel at all? So go on ahead and just give it a look real quick, see what you think. We'll go on ahead and move to the next page. So the purpose of this is really, when you see this from a different perspective, you can gain some insight. The first image that we saw there on the left actually contains 2 gray circles, which are the same size. In the middle, it's the same story, but from this perspective, you can see that both of those gray lines are in fact equal. And then to the far right, with a slightly different perspective, we can see that all of those lines are in fact straight. What these images present is the fact that our perception changes given this format. And it shows that we can't really rely solely based on our perceptions, our gut, our feelings. It proves the fact that investors tend to rely on perceptions and feelings, making the same mistakes over and over again. Most importantly, this is meant to help us understand that our irrational tendencies tend to be systematic. So the point here is, if we can identify those behaviors early and become aware of them, perhaps counteract them on a moving forward basis. So going to the next slide. This is a common paradigm called the efficient market theory that's really widely accepted in the investment world. As you can see here, the efficient market theory assumes that all security prices are efficient and incorporated and is all public information. It also assumes that it reflects all values that are true at any given time, that they're true. But what's a little bit flawed in this thinking is that asset allocation within this school of thought relies on the markets not only being efficient, but on rational investment behavior.
Investor behavior.
What did I just say?
Investment.
That's what I meant.
That's what you said.
Thank you very little. But you guys know where I think this is going. If anything, we can basically understand that investors frequently don't act rationally. So this entire thing has given rise to a field of behavioral finance, which is the subject of this. And hopefully with what Rob's going to be showing us, we're going to see how emotions and perceptions tend to influence investments and decision making going forward. So, Rob, let's look at some of what those patterns are.
Yeah, so thanks. What slide are we looking at now, Jackie?
5.
We should be on, yes, there you go, thanks. So what we're going to do in the seminar, that was a great setup, by the way, Barry. Thank you very much. What we're going to do now is cover these patterns of investor irrationality so that you can be aware and recognize these patterns and tendencies within yourself. And they are the following: overconfidence, hindsight bias, short-term focus, regret, mental accounting, and hot hand fallacy. So we're going to talk about each of these so that you can, hopefully identify the blind spots that may be existing that you didn't know about. You can identify behaviors that you have that you weren't aware of. And most importantly, so that we can bring to light issues that you can avoid repeating over and over again so that you don't keep making the same mistakes. But before we do that, why don't we do this? Why don't we get into poll question number 1? And is that up on the board now? Okay, so if you would participate here, poll question number 1 asks you this: consider your driving ability in relation to others on the road. Do you consider yourself better than average, yes or no? So go ahead and make your answers. We'll give you a few seconds to dial in. Again, the question is: consider your driving ability in relation to others on the road. Do you consider yourself, your ability, better than average, yes, better than average, or no, not better than average?
We'll just give it a second because it's a little delayed, but they're coming in. A lot of people think they're good drivers.
Yeah.
I said no.
So where are we at so far, Jackie?
We've got 89% yes and 11% no.
Now, there's a disconnect right there.
Okay, so 89% of you have dialed in that you, considering other drivers, you are above average. So with that in the back of your mind, let's go ahead and go to the first pattern of irrationality, the next slide, which is overconfidence. So overconfidence, this pattern of irrationality, is rating oneself or yourself as above average when it comes to selecting investments. The implications of overconfidence: 1, miscalculating the probability of good outcomes; 2, focusing on the potential upside only of investments and de-emphasizing the potential downside. So the same poll question I gave you has been given in the past in these investor behavior studies. Exactly same question. And typically 80 to 90% of the drivers consider themselves above average. Now, obviously, if you haven't already concluded, that is mathematically impossible, right? So average is average. There's some of the population is above average, some is below average, but it's impossible to have 90% above average. And so what that should tell you and tells me is that overconfidence, how we assess our abilities, whether it's driving or investing, we tend to overestimate our abilities and rank ourselves as above average. In a similar survey, I'll just share this before we get to the next slide. Investment managers, so in professional money managers, were posed with a similar question. Are you average at your job or above average at your job? 74% of a sample of 300 investment managers said that they were above average at their jobs. And many, to even overemphasize the overconfidence issue, many wrote comments along the lines that said, I know everybody says they're above average, but I really am above average. So the takeaway here is overconfidence is influencing our investment decisions. We're humans. We like to be right, and we like to think we're right. And that impacts how we invest.
Even on I-95?
Even on I-95.
Okay. Next chart is really, really telling of something that Rob and I see, and perhaps you guys have experienced. This is a graph which represents false perception and how it's affecting performance over this period from 2005 to 2021 regarding emerging market stocks. You guys have probably seen these, you know the drill. The vertical axis on the left is representing the returns, and the horizontal axis on the bottom is showing the years consecutively from 2005 on. I ask you to call your attention to the leftmost side of this graph, which case you'll see those three teal bars, which show the returns of this market at 34.5, 32.8, I think at 39.8, I can't read that. So overconfidence is basically an issue where if you had looked at these, you could have perhaps thought, well, this is a trend. You look at these impressive returns for this period, and based on that stellar track record, you might have expected 2008 to be a stellar year, right? Well, wrong. As you can see in that year, that index fell by over 50%. The important thing as a transition from what Rob is saying and what this shows is that one period of returns may be enough to create overconfidence in investors and, in fact, even money managers. But we should all avoid overestimating our ability to predict future outcomes based on past trends or performance. Concentrating only on this upside potential can obviously lead to really, really poor performance over time. It can be dangerous. So important to take a long-term perspective in viewing your investments and your strategy.
So what you're saying is the overconfidence factor when we rate ourselves is better than average, could lead us to see trends that we think exist on a chart like this that really don't exist.
Exactly.
Okay, gotcha. Okay, so that's overconfidence. The second, let's see here.
Hindsight bias.
Yeah, yep. Pattern number 2, hindsight bias. Tell us about that.
See, well, hindsight bias, Rob, is actually, as we're going to see at the end, I'll start from the end from the beginning. There's actually a relationship between the two. As you look at the graph, it says that believing that unpredictable past events in retrospect were obvious and predictable. Geez, I wish I knew that. I wish I knew that was going to happen. Well, I did know that was going to happen. We see that frequently on sports shows, etc. I knew that was going to happen. That's the effect. If you could really correctly recall your beliefs in any given day, you're in a minority. I certainly can't. But this pattern of behavior tends to promote overconfidence. We become angry and regretful about failing to avoid what appears to have been an obvious outcome. So based upon that tendency, it tends to lead us to overconfidence. Hindsight, in short, tends to lead to and is a bridge to overconfidence manifesting in decision making.
So the next slide shows a couple of good examples of where hindsight bias could have been associated. So if you look at this graph, on the top side of the graph, we're looking at from 1992 to 2006, the technology bubble. And as you can see, technology stocks grew quite dramatically, 94, 95, up until 2000, 2001. And then they fell precipitously. And in the chart below, we see the real estate market from 1991 to 2021. And again, we saw quite an impressive appreciation in the real estate market up to 2006, which was followed by a pretty precipitous fall down from 2006 down to 2016, where it leveled out. The point I'm making here is that many people, when asked after the fact, they said that these bubbles or these spikes or overvaluations in technology or in housing were obvious, that they were foreseeable, that they were predictable. And let me just leave you with this. If everybody knew, or the majority of people knew, that the bubble was predictable, there wouldn't have been a bubble to begin with. So be aware that thinking that something was obvious after the fact is a very common process for us as humans to armchair quarterback a game after the fact, or to say the guy never ever should have gone for it in two, or the quarterback shouldn't have gone for the 2-point conversion. They should have just done and kicked the extra point. Always easier after the game is over, after the shot has been taken. It seems obvious, but in the middle of it, it's not. And this hindsight bias makes us think that we're smarter than we are, and leads to overconfidence.
Absolutely. So we go on to the next slide. We've got short-term focus coming up, slide 10.
So this is the third pattern of irrationality?
Third, fourth?
Third.
I think.
Okay,
Yeah,
so short-term
number
focus.
3.
All right.
So this is not rocket science. We all tend to identify with this, but we tend to be sometimes short-term focused and lose the forest from the trees. As you can see, it's defined in terms of behavior investment-wise is inappropriately focusing on the short-term risk versus long-term risk. So just case in point, what's been going on with the markets of late is probably very, very telling and very much feeds into this. Short-term focus is basically inappropriate focus on short-term risk as opposed to long-term. Most investors have long-term plans, which we're trying to achieve, yet short-term behavior sometimes dominates and results in frequent trading or overreacting, excess caution, et cetera, et cetera. It's imperative that we all resist temptation to do that. So, Rob, I guess I put it to you, why is it that we investors do this? Is there something on the next slide that's going to give us a clue about that?
Not on the next slide, but we don't have a slide for this, but what I'm going to go over is why people act in the short run, why they sell in a bad market like we're in right now, why they tend to panic when the market's down. In other words, what causes people to act in the short term when they have a long-term goal? And it's this. There's in the field of psychology, we refer to it as fight or flight syndrome, and many of you guys have heard about that. But when the market's down, particularly when it's down dramatically, that could have been the Great Recession of 2008. It could have been the big dip we had in COVID of March of 2020, when the market was down 25 or 30%. It could be now. I mean, some people are acting irrationally right now about the short-term move in the market. And the reason people do that is because you get the same physiological reaction in your brain when the market's down that you do when a bus is speeding at you at 60 miles an hour and you need to get out of the way in order to survive. You experience the same physiological reaction when the market's dipping precipitously as you would back in the caveman era if there was a saber-toothed tiger chasing you and you had to avoid it, outrun it, outmaneuver it in order to live. And that reaction is, your brain, your amygdala releases epinephrine and norepinephrine. Your pupils dilate, your digestion slows down, your heart rate speeds up. All your survival instincts kick in just the same as if you were about to get hit by a bus as it does when the market's down. To avoid getting hit by the bus, you've got to do something. But when the market's down, you're better off just doing nothing over the long run, because fiddling with your account when the market's down severely impairs long-term performance, which we'll show in a second. And I'll make one other note about physiology and how we react as investors. The same thing happens when, in terms of greed. So not just fear, just the fear reaction, but greed. So, your brain, when you think about winning the lottery, your brain releases serotonin and you get a pleasure effect. We get the same thing effect when we think about buying something and making money, like a stock. We get the same feeling of pleasure because our brain releases serotonin. And even though we haven't bought the stock yet and we haven't made any money on the stock yet, we're still feeling the pleasure. And it tends to also influence our investment decisions, and greedy decisions can be just as dangerous as fearful decisions.
So it's systemic.
Yeah. It's physiological and systemic.
Yeah, good point.
So slide 11 the next slide, Jackie, is just going to emphasize this a little bit, and then we'll do our next poll question. So what this slide is showing is there was another study done, investor behavior study. Two groups were involved in the study. Group one on the left-hand side, they were only exposed to investment returns indicative of a 1-year period. Group two was exposed to investor returns over longer year periods, over 30 years. So because there's more volatility in 1-year periods showing more risk, and there's less volatility over 30-year periods showing less risk, the point is that the group on the left, because they saw more volatility, chose more conservative portfolios than the group on the right. And what this is showing is that the frequency of your exposure to returns impacts your investment decisions.
Right.
So let's go ahead and do poll question number 2. So poll question number 2 is this. According to investor behavior studies, which investors had better results? Those who looked at their accounts daily or on a more frequent basis, those who looked at their accounts less often, only 1 to 2 times per year, or C, neither. Both groups did about the same. So again, the question is, according to behavior studies, which investors did better? A, those who looked frequently, daily at their accounts, those who only looked once or twice a year at their accounts, or C, neither. Both groups did about the same.
100% so far saying B.
So smart group out there, I think either you've heard this or you're paying attention or you're getting the gist. That is absolutely true. The investors who didn't look on a frequent basis, didn't allow the media on a daily basis to influence what they did, their performance was better than those who looked all the time. So well done.
Yep.
So now moving on to slide 12.
Slide 12 and what was just discussed couldn't be a better segue into this slide. As you guys look at this, it's a chart showing coping with near-term fluctuations and the probability of losing the market from this period of 2002 through 2021. The probability is represented on the vertical axis and the periods, daily, monthly, quarterly, and annually along the bottom. What this is showing in short is the 30% delta between the probability of losing as represented on a daily versus annually on the far right, which I think you would agree is a pretty big number. So what Rob was just talking about and what we were just talking about in terms of short-term focus is really played out in full detail right here on this chart. Couldn't be said any better. Important thing is to have a system and to have a process, but to do something with alarming frequency is actually counterproductive.
You're more apt to have a down. 45% of your account's going to be down, but only 15% of any given year is your account going to be down. So the longer your horizon, the less probability of loss. The less often you look, the better off that you are.
Correct.
Okay.
Now we're going to regret. So this is a little bit of a high level, but as is defined here, it's having feelings of guilt because of a poor outcome. That happens with some frequency. In terms of investments, this is frequently manifested when a poor judgment has been made and the investor suffers regret and displays, this is the key, a disproportionate or illogical feeling over that poor outcome. And the way this manifests is that it makes the investor face current and future investment decisions based on this one event of regret in the past. Fear of regret can cause people to become ridiculously overcautious, but it can also, related to what Rob was talking about before, produce the opposite pole and make somebody take greater risk, perhaps in order to make up for what they regretted. I think we've all seen this in some regard in some of our portfolios, and it's something that's to be avoided. So the key is to make sure that you look at your initial investment process and keep that in mind. So fear of missing out is just as much caution or something to be avoided as being overly cautious.
So as it applies to regret, before we go to the next slide, I'll share one other thing about how we experience pleasure and pain, because it goes hand in hand with what I'm going to talk about in terms of how regret impacts our future investment decisions. So we experience the pain of a loss at twice the degree that we experience the pleasure of a gain. So I'll say that again. We experience the pain of loss at twice the degree that we experience the pleasure of gain. So, for example, let's say I walk into the Wawa and I buy a scratch-off lottery ticket and I win $200. And as I walk out, I see that I mistakenly, accidentally parked in the handicap spot and the policeman is writing me a ticket for $200. I'm feeling much worse about the ticket than the excitement I felt about winning the 200 from the lottery. I experienced that pain of loss at twice the degree that I experienced the pleasure of the gain.
True.
So that's how this plays. We'll go to the next slide, and I'll use this example, and I'll show how regret, two types of regret, impact your future investment decisions. Two types of regret. So if you look at the chart, we start at the left-hand side. We see investor A purchased shares of company ABC in 2006 for $10,000. And if you move to the right, you see that investor A, the stock went up and then it went back down. The investor sold the stock for about the same as he paid for it in July of 2009, didn't make any money. At the same time, we'll look that investor B considered buying ABC at July of 2009, the same time investor A sold it, but didn't. And then if you look to the far right-hand side of the chart, you can see how much ABC company was worth at the end of 2015, $120,000. Neither investor A nor investor B enjoyed that appreciation because investor A bought the stock and then sold it before it got to 120. Investor B never bought it at all. So investor A experienced regret because of a bad outcome. In other words, investor A took action, it didn't work out well, and so now investor A has regret because he sees that it's worth 120 and he got none of that. Investor B also has regret, but not because investor B did something, because investor B did nothing. Investor B considered buying the stock, but didn't buy it, and lo and behold, the outcome is the same. It's worth 120. So here's the thing that you would assume. Logically, the economic outcome is the same. Neither investor got the 120, so you would think that they would both have the same amount of regret, but they do not. Okay, the regret of doing something, investor A, we call that commission, is far greater than the regret of doing nothing. Okay, and so how does that play out into future investment decisions? I will summarize it, cut right to the chase. People who regret making poor investment decisions, like investor A, they did something, it didn't work out well, they become less risky going forward. People who regret not making a decision, like investor B, doing nothing and missing out, they become more risky going forward. So there are two types of regrets, right? Commission, having done something, and omission, having done nothing. But what's important to know is that that regret that you experience is influencing decisions you make in the future. And you need to be aware that it's influencing. It needs to no longer be a blind spot for you. that you don't know is influencing. I mean, it's like when I was in high school, right? And I asked the girl out and she said no,
No,
right?
there's no way that happens.
I'm going to be less apt to ask again, right? I'm going to take less risky, shoot, lower the bar, do something different to increase my chances, have my buddy ask in advance, right? So anyway, that's regret, and it's real, and it does influence how you make future
It
decisions.
sure does.
Okay.
Yeah.
Should we, so let me just pause for a second. I think we neglected to field questions. So I'll just put the invitation out there. If you have a question about anything or you want clarification on some of the things we're talking about, put it in the chat. Jackie will let us know that it's there, and then we'll be able to address it for you. So in the meantime, why don't we move on to pattern number 5, which is mental accounting.
Yeah, we're both going to go ahead and try and take a look at this, but as everyone can glean, that these aspects or certain aspects of this, quite frankly, exist in all of us. They really do. The issue is that if we have awareness of them, we cannot be captivated by them to have them dominate us. Mental accounting is one of those things that I was talking about this with Rob in doing client reviews or going over people's statements. I would have loved to have brought a statement today to show you, but this market's not really permitting that, and that's this. If you were to have 10 stocks sitting here in front of you, if I were holding it up, and 9 of those names were in the black with double-digit gains, but there was one stock that was in red, and it was negative 9%. The tendency for the person that does mental accounting is to focus on the one red negative number and lose the rest of the gain that's there for the whole sum of the portfolio. Make sense?
Makes sense.
It's a tendency to have focus on the black spot on the white sheet of paper. You see the spot, you lose the rest of the paper. Mental accounting compartmentalize investments while ignoring the overall aggregate. And I don't know of a better way to explain it than that. It's important to remember that the sum of the parts is more important than each part.
Yeah, exactly. So investors do it all the time. They want to get rid of that one thing on the statement that doesn't look like it's pulling its weight. But invariably, if it's a well-constructed portfolio, that item that seems like it's not pulling its weight at the moment is there for a reason. It's like having 9 players on the baseball diamond. You have a shortstop, it's there for the reason. He's there or she's there for the reason. If the shortstop's having a slump, it doesn't mean you pull the shortstop off of the field and leave that section of the infield wide open. You still have a shortstop on the team or in your portfolio for a reason. And so, but investors tend to look at only that weak spot and then they want to do something about it. Another analogy, which I think works really well, if you're on 95, particularly in that 5-lane segment somewhere on the eastern seaboard, and you're in a traffic jam and your lane's not moving, you tend to want to get rid of that lane, move into another lane. And my experience is that once I've done that move, the lane I was just in starts doing really well. All of a sudden, the shortstop comes out of their slump. They're hitting well, they're fielding well, and the lane I move into all of a sudden stops moving. So, and in golf, we have 14 clubs in the bag, and if you're putting lights out and your last round you only had 25 putts and you didn't miss anything inside of 12 feet, you're still going to bring your other clubs. Or if you're not driving well and you're having trouble off the tee box, you're not going to just ditch your driver for the rest of your life. The driver's there for a reason, the 7-iron's there for a reason,
right.
5-iron's there for a reason. And in this particular pattern, if you have a well-built portfolio, it's important not to focus on just one thing. Know that body is all working together. That body, the component, that body of parts, the hand, the leg, the ear, the eyes are all working together for the good of that body.
Exactly.
And you can't just ditch one because it's having a rough time or you sprain your ankle.
Yep. Really good point. In fact, the next graph is basically going to sing the same song and show it in a graphical format, perhaps better than anything. As you guys take a look
Not
at
better than what I just.
well, you're right. Forgive me for that. You're absolutely right. This chart is showing mental accounting from a 51-year perspective of 1970 to 2021. And as you look at this chart, these 6 categories, you're going to see for each asset class, for example, on the top left at 11 o'clock, international stocks with a rate of return of 9.4 and a risk level of, I can't read it.
16.8.
Thank you, very little. And as you go from left to right, you'll see large stocks, small stocks, the total portfolio, et cetera. What I want to call to mind is this. Bonds are, in the bottom left, are an asset class that have traditionally tended to be viewed as conservative, having lower volatility and risk. Stocks, which are on the top right, tend to be associated more with risk and have obviously a higher rate of return, and as measured here, a higher degree of risk. To the point that Rob and I are sharing, as you look at combining all of these asset classes together, on the bottom right, you see the total portfolio has a return of
9.7.
And what is the risk?
9.6.
Thank you very much. Importantly, when you compare that to, example, the bond portfolio, you'll see
Better
that
return.
you've got better returns, actually rivaling the returns that you see on large cap stocks, but you're seeing it with a lower overall portfolio risk level than a conservative investment like bonds.
Sure.
So indeed, the sum is better than the parts.
Yeah. You need all the clubs in the bag to shoot par or below par.
That's exactly right.
Yep.
Or 90.
Or 90, depending on whether it's Jackie
Still
or
need all
Rob.
the clubs.
Yeah, you still need them all. Yeah, you got to have them all. So, any questions?
Comments on how good it is. Good stuff.
Oh, thanks.
Cool.
Okay, appreciate that. Appreciate the feedback, guys. Thank you very much. So the last pattern is called the hot hand fallacy. So this is perceiving trends where none exist and consequently taking action on this faulty observation. So the implications of the hot hand fallacy, and this is the biggest one that I've seen in my whole career, is investors' desire to invest in last year's winners, favoring a hot money manager, hot mutual fund, or hot asset category. So here's an example that might be real for those of you out there that have a 401k, through your work provider, you have a simple IRA. On that, in that account, you have a menu of options to choose from. And when you look at the menu, what many investors do when they're deciding, hey, what funds do I want from the menu to invest in my 401k, the most common methodology used by participants is they look at last year's best performer.
That's true.
And this is a great example of the hot hand fallacy. When selecting a money manager on a 1-year return, or even attractive returns the last couple of years, could cause you or other investors to drop their current holdings in the portfolio in favor of this new, what looks like the hot thing or hot manager or hot fund or hot asset category. So I don't know what would be an example of a most recent hot asset category. Tech, growth stock.
I'll tell you the one I'm thinking about that's coming to mind for those that own it, may be able to think this, but Netflix.
Yeah, so
you had Netflix 5 years ago, 4 years ago. You may have looked like a hero.
It was, yeah, so it was most recently worth around 600 or 700, and now it's around 190. So it's about a 70%.
That's not a fun ride.
No.
But if somebody had jumped in right before it began, that's kind of an illustration of a little bit of what you're talking about.
Yep.
Yeah.
So again, it's looking at 1-year return, perceiving a trend. No trend exists. Why would you perceive that? Maybe you have overconfidence, like the rest of us who rated ourselves as better than average drivers, right? Or maybe you're suffering from regret of an action that you didn't take, so you want to vote for this manager who's made all this money to try to make up for investment decisions that you should have made that you didn't. Either way, hot hand fallacy is definitely something that's very common. So what I'm going to try to do now, Barry and I are going to do, is try to bring this to a conclusion. And we're going to do that by doing 2 more poll questions. So we'll pause for Jackie to put up this next poll question. Okay, so the question is this: over the past 30 years, what is the difference in return between the S&P 500 index and the average individual or retail investor like you or me? So in other words, another way to ask this is, how much better did just the S&P index, an unmanaged index, do than the average investor? Was the index 2.5% better than the average, 3.5% better than the average investor, or 4.5% better than the average investor? So I'll give you guys a couple seconds to put in your answers. We know that the S&P has done better. To what degree did the S&P outperform the average retail investor? 2.5, 3.5, or 4.5?
50, kind of split between 3.5 and 4.5.
Okay. All right, so let's go to the next poll questions. Okay. So the right answer, by the way, is 3.5. Let's go ahead and go to the next poll question. Okay, so now that we know the answer is 3.5, if you apply that 3.5% underperformance variance of the average investor to a $100,000 investment over 30 years, what's the underperformance in dollars? So in other words, if we look at the past 30 years and we invested 100 grand, what's the delta between what the S&P did and what the individual investor did? Is the difference in returns 300,000 total at the end, 600,000, 900,000, or 1.2 million? Couple more seconds. What do we got, Jackie?
900K is leading.
So that most people said 900,000, and what was second place?
Kind of split between 3 and 6, mostly 6.
Okay, so let's go to the next slide. Let's skip that. Go to the next one. Okay, so we'll come back to that, right? So what this is showing is the answer to your question in terms of the difference between the poll question number. The first one was the delta is 3.5%. If you apply that delta to a $100,000 investment over 30 years, the S&P did $1.2 million better than the average investor. Not 300, not 600, not 900, 1.2 million. And the point here is that if you say, hopefully you're drawing the conclusion that the reason an unmanaged index with no oversight, with no stock picking, with no advisor help, did better than the average retail investor by 1.2 million. We just shared with you why. We just shared with you that our emotions get in the way of our logic, that we have patterns of irrationality, that we feel overconfident in our abilities, that we experience regret, that we have tendencies like short-term focus and hindsight bias and a hot hand fallacy.
Yep.
And so the main reason you see that gap is because we're not machines, we're humans. And we're not artificial intelligence, we're not robots, we have a heartbeat, we experience fear to a great degree, we experience love to a great degree, and we experience greed to a great degree. And those emotions can wreak havoc on our investment decisions. So this hopefully was a way to shed a little light on why you behave the way you do when it comes to making financial decisions about how you invest money.
Yeah, really, really good, really telling. What was not up here, but it's just a dovetail with what you said, is the institutions tend to perform better for the reasons you just enumerated. It's a lot less emotion, and they're following a disciplined process that doesn't take a lot of that into play.
So what does that mean, institutions? How do you define institutions for our folks on the webinar that do better than individuals? Who are these institutions?
Not all, certainly, but as a tendency, you'd have large foundations.
Foundations, okay.
Some of the hedge funds that have actually had long track records and been on the street for a while. But most importantly, people would recognize this name, Warren Buffett.
Mm-hmm.
Warren Buffett would isolate quality. He'd accumulate it when it was fairly priced. He'd identify good management, buy the stock, and hold on to it. And he'd ride. That was his process. So whether come hell or high water, he didn't have overconfidence, short-term regret, short-term focus. None of those issues affected him. He has a particular means of investing. He's a buy and hold value investor, and it's obviously placed him among the best in the field.
So the key word I heard there was process.
Yep.
So investing without a process, right? Just by the seat of your pants.
Is speculation.
Or by a gut feeling.
Right.
Or by a hot tip. Can be problematic. But if you have a process, then you act more like a institution, like an endowment, or like a foundation, or like a pension fund.
Correct.
Because you have a process that says we're going to buy these, own these, hold these. And then when the news changes or the world changes or the market changes, you stick to your process.
Amen. Couldn't have said it better.
Fair enough. Any questions from our group?
We do have a question. As market conditions change, what is the best way for me to adjust my portfolio accordingly?
I think that's a perfect segue into the last chart if you want to show it.
Back up one slide.
That's a great question, whoever asked it. As you guys see, I'm wearing the wrong glasses, so I'll do the best I can. Whoever asked that question, I think the answer is going to be shown here. So I'm going to state the end from the beginning. The key is to actually have a diversified portfolio that is supporting a plan that's in place and doing a systematic rebalance, bringing all of your asset classes back into line on a specific date with a specific frequency, let's say annually. This chart is one that tells a lot of what we've been talking about here. If you let your eyes focus on the gray, if you look at the gray boxes, and you compare it to the top versus the bottom, what conclusion, Rob, would you draw?
That there's not a lot of volatility in the gray boxes. They tend to kind of accumulate right around the middle. Is that where you're headed?
That's exactly where I'm headed. The gray, all of these colors are represented and defined on the right. So you'll see that the teal blue is large cap stocks. The small caps are represented, I think, by the dark blue, international by orange. The gray is the diversified portfolio. And what Rob just said is really important. It is not at the high and it's not in the low. In fact, the investor in 2015 that owned this portfolio had a negative 0.7% rate of return, 2% lower than the top asset class of that year, which was large cap stocks. However, the diversified portfolio would perform better than the worst class, small stocks, by about 3% this year. By having a diversified portfolio, it mitigates those risks. You're not getting all the highs, but you're certainly not participating in the lows. Rebalancing keeps your portfolio in the proper balance and takes care of that entire process. So you can't go by looking at what the best asset class was in 2002 or whatever that is at the far left, because the orange international at the top was down near the bottom the following year, and so on and so on and so on. The diversified portfolio rebalance does the best over time.
Yeah. And the other comment I would make is that if you have a well-diversified portfolio, typically the answer to what should I do as market conditions change, typically the answer is nothing. if you have a diversified portfolio, other than an annual rebalance so that you're putting your allocation to large cap stocks back to where it's supposed to be, and international and small cap, et cetera, where they're supposed to be. But in the middle of changes in market conditions, whether it's a big bull market ride up or a correction like we're in today, typically the answer is you should do nothing.
Correct. The rebalancing takes care of it.
Unless you know, unless you're looking to deploy new capital, meaning you're saying, what should I do with cash that's on the sideline? Then you could systematically deploy that capital in a market like we're in today by averaging, if you have $10,000 that you want to put to work, you could put in, $2,000 a month over the next 5 months during this downturn to take advantage of the lower prices. But with the core portfolio, the answer typically is do nothing. Because look, over an investment cycle or over your investment time horizon, this temporary pullback in the market is exactly that. It's a temporary impairment. 5 years from now, it's going to be a blip on the radar, and it's going to be irrelevant what happened today. The market, goes up over the long run on an average of 9% for a reason. 67% of the time it's up, 23% of the time it's down. So what shouldn't you do to your portfolio as market conditions change is drastically take more risk if the market's going up or drastically sell if the market's going down. Those are the two things you shouldn't do as market conditions change. I don't know if that helped. I hope it did. We'll have our information at the end. You're welcome to give us a call, and we're glad to talk to you individually about that question.
Perfect. That was the only one for now.
Okay. Well, thank you, Jackie. Thank you for everybody who participated, all of you guys who are members of the South Florida PGA. We're glad to be a resource to you. We're excited about our PGA Hope tournament next week at Lost Tree Club.
Absolutely.
I think it's our 6th or 7th annual.
Yeah.
Got a lot of momentum. Going to help a lot of veterans with the PGA Hope program. Well, enjoy the rest of your day. Enjoy your week, and we'll talk to you soon.
Take care, guys.